I'm making this video because it's a topic that everyone talks about. There's no clear-cut answer either, but it's really, really important. That topic is buying dips and what happens during crashes, corrections, and panics. And I'm just going to start the video off by reading a few stats to you that I've compiled just by doing research, reading around, and going through some reports. So Wall Strategies writes, out of over 20,000 trading days in the past 92 years, there were 85 days when the S&P 500 declined by over 5%. So 5% in a single day does not happen often. 20,000 trading days, it's happened 85 times. That's a daily crash, by the way, 5% a day. This one from Wes Moss, there have been 20 such full bear markets since 1928. Average that out, and we've had a bear market once every 4.5 years. So a long bear market once every 4.5 years. From Guggenheim, they write declines of 5% occur about 1.5 times per year. Market declines of 10% occur 0.5 times per year. So 5% declines are pretty common. I'm just going to clean up this spelling mistake here. But 10% declines, not so much. One more here from Bespoke says the median decline for the S&P 500 in the 95 prior corrections was a decline of 16.4%, and it took 64 days. So sometimes these take a long time to play out. And then the last one from the Motley Fool says, over the past 50 years, it has taken an average of 336 days, or about 11 months, for the S&P 500 to fall 30%. I hope each of these stats helped you. We're now going to quickly dive into the strategy and point of this video. So we have these facts, and let's go to the S&P 500. And what we want to now do is just talk about what buying the dip means in a simple buy the dip strategy. This is literally so simple, a 5-year-old could do it. But remember, it doesn't mean or guarantee anything. Markets are really hard, so watch this, do with it what you will, and give it a test, back test it, paper trade it. You get the idea. So we now know these stats, and one stat that we absolutely know is that 5% corrections are pretty common. They happen 1.5 times per year on average. So we can kind of start to draw on the S&P 500 these corrections, and we can just keep drawing. Let's just have fun. Let's just draw a bunch of corrections on this chart. Let's do it. We're just going to pick the top and the bottom, pick the top and the bottom, pick the top and the bottom. Let's zoom out even more. Pick the top and the bottom. Let's zoom out even more. Pick the top and the bottom. And what else do we have? Pick the top and the bottom. So what we're doing is we're just picking out these dips, and we're just marking these corrections right on the chart, because this is where the strategy begins. The first thing is just visualizing it. It happens. Sometimes there's epic crashes, going to be even more difficult. But hopefully what this video does is just kind of gets the brain working to see some opportunity from time to time. So the first thing is this. If you're looking to buy a dip, what should stand out right away is a 3% drop is not a dip. That's not really the dip to buy. Because when you look at what a real correction means and the stats and how rare it is, if you're really looking to get an abnormal price action, and we will go back to these stats right now actually, you have to be ready and willing to wait for something actually significant. So for example, a 5% decline happens 1.5 times per year. A 10% decline happens 0.5 times per year. Okay, so we can run with that information. So this buy the dip strategy, then, one simple way to do it is you look at price and you say to yourself, I know that a 5% correction happens 1.5 times per year. I'm going to do the math on that. Draw about 5%, maybe give yourself a little wiggle room, 5.5%, and add it to your chart, your data, whatever you need to do. And then set an alert at that level, or go on to your brokerage and place a limit order. So in this case, you aren't chasing price. You're not following the price action every day. You just drew a 5% correction from the latest price, set your order or your alert, and then walked away. because you know it happens on average 1.5 times per year. Now, price could keep going up. So of course, if price were to go like this over the next few days, well, you'd have to redraw your 5% correction, quick dip buy. The next stat that you want to run with is the 10% correction. Happens 0.5 times per year, so it's not as common, but that's really where you could get a dip. And on your chart, you could just draw it out, 10%, mark it, set an alert, walk away. So that's the key to this dip buying strategy. This is not you could automate this. You could automate this very, very easily. Just a rolling calculation, 10% from its latest high, buy the dip. A rolling calculation, 5% from its latest high, buy the dip. But like we said, there is no guarantees in markets, because one really important thing you cannot forget, it's so important, is, let's zoom out, is sometimes these corrections are actually rather big, and they can get worse. A great example, over the past 50 years, it has taken an average of 336 days, or about 11 months, for the S&P 500 to fall 30%. So these 30% corrections don't happen often, but when they do, they drag on a long time. Another example, the median decline for the S&P 500 in the 95 prior corrections was a decline of 16.4% over the course of 64 days. So now you have these numbers that you can begin to work with. So the point being is, some people will see a correction happen, say that they see just like the smallest little blip, and they go rushing in. But if you have this data in mind, if you look back to see the extent of some of these crashes and corrections, patience is essential, and just planning out ahead of time. So that's really the key difference here, as well, is what we're doing in this video is we're actually planning out ahead of time. We're laying out the levels on the chart. Doesn't matter if the chart goes to the moon, if it just rips higher. The point is we're just planning and preparing so that when it does happen, we were ready for it. That's a way better position to be in than just blindly buying, and then all of a sudden you get blindsided, or just a shock happens and you weren't even thinking about it. And that's really the key to this video, is understanding the history and the data behind corrections, and then planning for them in the future. It's the only thing you can do. No one ever is going to predict markets perfectly or know exactly what happens, but you can plan for them. And with the right stats, with the right mindset, maybe, just maybe, you can be a little more prepared for a correction or crash than the average person. So here are all the stats again. You can press pause if you want to reread these. I'll also add them in the description. They're meant just to get that mental framework going. Okay, now you know this stuff happens, but some corrections are occur obviously more often than the deeper, longer corrections. And one more thing that we will say to this too, or that I will say to this, is that corrections, if they are real, if they really are going to extend a long time, and it comes from this stat here, over the past 50 years, it has taken an average of 336 days, or about 11 months, for the S&P 500 to fall 30%. What's important about that is you now know that you can kind of see that corrections, when they really do happen, or crashes when they happen, they can get dragged out a long time. So that's something to really keep in mind. And this is the 2008-2009 crash here. And one thing you could take a note from this is, let's just draw the 10% correction here. So you can see the 10% takes us to the end of this. Oops. Takes us to the end of this candle here. And it was a decent dip buy. You would have actually gotten flushed out kind of hard. Nice bounce to maybe break even. And then let's just say you had held on. Well, at some point the signal was telling you that dip buy didn't work. And you had, how much time is this? We can actually just measure this really quick to see how long did this correction last. Wrong drawing tool. Date range. It lasted 490 days. That's 490 days of going down. And the point of showing that is that there's moments when there's time for an investor or trader to look and say, I'm out. I tried to buy this dip. I tried to get that 10% correction. I tried to get that 5% correction. I'm going to lose money on this trade, but it's actually going against me so fast and it's playing out so bearishly. I just want to get out before it gets any worse. And that's kind of the point of that, is if you are buying dips, it's important to keep in mind that these can play out over a long enough time frame to where you have time to recalculate the position and get the heck out of there. Now, of course, the COVID crash was unlike anything that's ever been seen. That was the March crash, and that's also the point of this video. Predicting markets is practically impossible. So this was only 28 days, and the extent of the crash was 30%. 30% in about 28, 30 days. It's unheard of. It really was it's a monumental time for markets, the COVID March crash, and here it is. And let's just draw out actually the 10% corrections here. So it looks like it dipped 10% here, and it just kept going. There was a bounce, it got down, then it dropped another 6% bounce, and then it just flushed. And what's really great about showing this example is that buying dips does not always work perfectly. And that's why risk management is key, because just because you do know the facts, just because you do know the stats that we talked about earlier, let's see if we can pull them up. Just because you know these stats does not instantly mean that you're going to be a winner. The point of this video and me showing you these stats about how these corrections happen and reading out some of the stats here that I just quickly researched and wanted to throw on this chart is just to make you think these do happen. I don't need to rush in at every dip, because there are numbers to wait for. For example, a 5% dip happens 1.5 times per year. A 10% dip only happens 0.5 times per year. And then also this element that the big crashes do not happen often. So they do not happen often. And then also that when the big crashes do happen, it sometimes takes a very, very long time. For example, the stats ain't 336 days, so you have time. But as we know, markets are pretty unpredictable, and the coronavirus crash is a reminder that while you may have all the stats and facts on your side, sometimes it can just totally surprise you. But knowing that and being open to that is half the battle sometimes, because then you won't be surprised when it happens because you already came to terms with it. Now, one more thing about buying the dip that is important about this video is this was all for the broad market. This is really important. This is for the broad market, the S&P 500 I'm looking at, or in the other case, the NASDAQ 100. If you're trading an individual stock or a forex pair or a crypto, well, you have to know the volatility of it. And a 10% on the S&P 500 in a stock, that might be more like a 30% correction, or at times a 50% correction, because it is one asset. It is not a basket of assets. It is not maybe a it's not an ecosystem built around it. For example, the S&P 500, there's dollar cost averagers, pension funds, people have their Roth IRAs, they have ETFs built into it. It's just a different animal that we're talking about when you're buying dips and indexes versus individual stocks. And as a great example is a stock like Amazon, back during the dot-com bubble, crashed from its high to its low 94%. It crashed 94% during the dot-com bubble. So and if you go to the NASDAQ 100, it crashed about 80%. So there was an extra 14% that got shedded on a stock like Amazon compared to the NASDAQ 100. Even if you go to the top tick here, let's actually do that. Let's drag this up. 82%. So stocks are just naturally individual stocks are going to generally get hit harder than the indexes in these types of moments. So all of this that we've talked about today, you have to keep that in mind. If you're taking this video to your individual stocks, super important that you remember that you probably want to double these stats and make them even more extreme, because the volatility on an individual name is going to be far greater than it is on an index. And let's actually just do one more example of that. For example, we looked at the coronavirus crisis on the S&P 500. We saw it dropped 30% in about 30 days. Let's see, 35% in 30 days. Well, let's say you at that time you happen to be long an airline stock. If we go back, we can quickly see this is United Airlines. United Airlines dropped 93%. So the index was down 35%. A single stock like airlines were down 93%. And you could probably do this across the board. Let's even just go to something, actually let's go to Apple, which was, at this point in time considered one of the safest assets. And we'll go to just a daily chart. And let's zoom out, and here it is. We'll click here. And it was actually down about 35%. So in rare cases, there are bellwether stocks that can hang with the indexes. Apple actually managed to do that. Were there any other names like that? We can quickly see Facebook. And this is just a study to really communicate the dip buying. This was down 38%. So you can see too that some sectors or industries will hold up stronger than others. And just to wrap up this video, let's go back to our stats one more time. And I'm going to paste all of these facts and stats into the description below. Wall Strategies, West Moss, Guggenheim, Bespoke, Motley Fool, thanks for providing these stats to use on the video. And you can read them below. If you have any questions, also feel free to ask those. And thank you for watching. I hope it helps you get started with just dip buying. And remember, there's no easy answers. This isn't going to help you just become a millionaire overnight. But my goal of making this video is just to maybe share some of the things I've learned. I also want to hear your feedback. I'm trying to learn in real time with you as well. And also just to get some information out there. There's so much misinformation about buying dips that just feels like a good thing to do, to just try to put this out there. Thanks for watching, and you can leave questions or comments below.